So very good morning, Prayas, good morning, Shanmu, good morning, Kirtika, good morning, Haindavi, good morning, Chantur TK, good morning, Nani, good morning, Aparna, good morning, everyone. Please assemble fast. We'll start with the today's session. Everyone assemble fast. We'll start with the today's class. Okay. So very good morning, everyone. So today in this session we are going to complete the basics of advanced financial management, which covers the concepts of time value of money and certain other basics. As I already said, the basics represent not just basic level understanding, the foundation for understanding the AFM, without which the subject becomes a nonsense. So the first two classes we spent a lot of time in understanding how the basics of finance works. Once the basics are completed, then we are coming into the first chapter for our EOB, which is the Advanced International Financial Management. The word why I used advanced is the concepts which we are going to deal are extremely advanced in nature, wherein we will see capital budgeting carried out in outside India, okay, working capital management outside India, and these are applicable both for CA as well as for CMA. Okay, and again, I wanted to reinforce my word one more time. These lectures are exactly applicable for CA as well as for CMA also. Syllabus is absolutely the same. Problems na copy paste. So I don't know this institute copied from that institute or vice versa, but problems are same, questions are same, numbers are same, except that one chapter called as leasing is added and digital finance is added for them, which comes to 6 marks in exam. Except that 6 to 8 marks, every single point is same across both the courses. Why means most of the people are also messaging me, sir, can I am from CMA final, can I also take this, can I also continue, because liveness, by the time you complete we will also complete, so separately we need to take out this one. I said very clearly, yes, you can. So syllabus is absolutely the same. The first chapter we are starting itself is a copy paste for both the institutes. So at the end, I just wanted to tell you, today we are going to first complete, okay, the basics inside the financial management as a subject. When I say financial management, any financial management you take, these are the basics. Today's section of discussion, what we are going to make with regard to the time value of money, is very interesting because it takes one important concept called as a reinvestment concept. Which concept here? Reinvestment concept. So what exactly this reinvestment means, how this reinvestment actually work, those things we are going to understand very clearly in detail in this particular lecture. Clear? Once that is completed, once everyone is comfortable with reinvestment concept, then we will be moving on into the next area. Okay, so even before we go into the next one, I just wanted to put before you this document. Just a minute. Okay, so you can see the document now. Everyone, can you see the document? First confirm everyone, those who are in live, audio and visual, both are clear? Audio and visual, both are clear? So see here, in the last session you copied this content. Just a minute. Okay, see here once. In the last session you completed this area. Okay, present value, future value. I just wanted to confirm this concept. See here, present value of any asset will be, okay, present value of any asset will be future cash flows divided by 1 plus r whole power n. 1 plus r whole power n. First point number 1. Just a minute, someone is asking it out. Yes, they are asking, put the PDF regarding the Forex chapter. Yes, sir. I will definitely share. Today itself I will share. Now itself I will share. Let us complete this. I will share it. Books are already dispatched and I wanted to show you, what is this? The new updated book as well. Okay, I will share it. You can see directly. It came super handwritten notes. And extra handwritten content also I am going to provide you as a PDF. 150 pages extra content also I have written. Okay, so we will put 100% of our best efforts possible. At the end of the day, you should turn out as an exemption student. That's it. That's the only thing. My wish is you should turn as an exemption student after all the hard work that we put. Clear? So why not that 90 marks is not achievable? It will be achievable. Let us target on that. If 10% or 15% get 90 plus, na, so how it will be? If everyone get exemption, how it look like? So we will try. We will try our level best till the last moment. Put your hard work. Okay? Never lose the faith. Let's start. Before going into that, present value of any asset is the future cash flows divided by 1 plus r whole power n. Okay? This is the formula. Okay? Why I am writing this formula is, listen carefully. This formula works for single cash flow. What cash flow? Yeah? Single cash flow means in order to discount 1 year cash flow, this formula will be useful. When you have written FCF, numerator consists of cash flow. Okay, numerator consists of cash flow. Means which cash flow? 1 year cash flow you are writing. Okay. So therefore what we will do? Present value of any asset will be, okay, future cash flows of any particular X year divided by 1 plus r whole power n. 1 plus r whole power n. Okay. What we have done, see here. In this question, I asked like this. 0 year, 3 year, 10% return expected. A person wanted to invest today some X amount. Okay, some amount. He don't know how much to invest. He is asking us, my end result must be 1 lakh. My end result must be 1 lakh. I wanted a return of 10%. How much I need to invest today? Do you know when this will be more useful for you? When you are paying the LIC premiums. When you are paying the LIC premium. I want this much of, okay, I want this much of surrender value when I attain an age of 50 years means how much I need to invest today? For that, this present value concept will actually work. Always I told you now, decision making, present value. Just knowing about what is going to happen after my investment, future value. Okay. So most of the times in FM, when I say most of the times, at least 95 out of 100 times, people uses only discounting. People use only discount because decision making is taken today. Then why I will be bothering about the future? I want future to come to present, not the present to go to future. Clear? So therefore, listen. I wanted to invest how much today? 0 means today. Third means third year end. How much I need to invest? 75,131, something, some amount you said. 75,131. But how to understand? 75,131 will be invested. First year I will get 7513, reinvest it back at the same 10% rate. Again you will get how much? 82 something, what is this? 8264. Again reinvest it back, it becomes 90,901. Then 9091 you will get. Then this total you need to take. So please total these numbers, yeah. Total these numbers and tell me. Okay, 24,868. Add it to this 24,868. Add it to 75,131. 99999, almost equal to how much? 1 lakh. Almost equal to how much? 1 lakh. Not almost, 1 lakh. So from this what you have to understand? After reinvestment only this achievement can be made. Okay. So if you wanted to achieve this 1 lakh, just you should not put the money and forget about it. You should also do another intermittent activity called as reinvestment. Then only this is achievable. So whenever you are doing bond valuation chapter like immunization strategy, I told you yesterday, I shown you bond valuation immunization strategy. The concept of immunization works on the basic principle of reinvestment. So that's why I told you basics here what we are learning are not basics for time pass. These are the basics at various levels of CA syllabus. Okay. So try to understand clearly. Entire CA syllabus there are so many concepts. Okay. In AFM, in that reinvestment is one very very important and interesting area. So we are first concentrating on that. Once this is clear now, remaining subject when you read now you will get a clarity. Clear? So anyway, so now the point is, what is the meaning of this formula? That's what the next target for us. Okay. So present value of an asset is future value of the cash flows of any one particular year divided by 1 plus r whole power n. Okay. In our example, present value equal to future cash flow. How much I want? 1 lakh. Divided by what is the rate at which you are investing? 10. Divided by how much? Power how much? 3 years. So 1 lakh divided by some amount 1.331 something you said. So it came to 75,131. When this 75,131 becomes 1 lakh, if 75,131, three things should happen. Number one, invest 75,131 at the rate of 10% per annum. Reinvest, okay, interest at the rate of 10% per annum. Number three, realize at the end of third year. Then only you will become, you get that 1 lakh. Just like that, put the money, interest comes, eat the interest, you will not realize your 1 lakh. Your 1 lakh will be realized if and only if three conditions are satisfied. Invest 75,131 today. Okay. Second, what you have to do after investing 75,131? After investing 75,131, you will get the interest after 1 year, 2 year, 3 year. Don't eat that interest. Reinvest that interest again. At what rate? At the same rate of 10%. Then you will get that 1 lakh after 3 years. If you don't reinvest any one of the cash flows during the 3 years time, you will not get that 1 lakh. Understood or not, everyone? Yes or no? I shouted my work over. Everyone understood? Here understanding should, again, I forgot. I just wanted to confirm one thing to all the students here listening. Whenever I say understood, your yes or no answer will come. I am not bothered about that. Yes, you will genuinely tell whether yes, understood or yes sir. If you don't understand, no, you will tell. But when I ask you, have you understood? I am not asking you about the question whether you understood or not. Concept. Numbers can change, question may change, but you should understand the concept. Then only you can do any problem. Sir, I may do 450 problems in class. Exam la 450 first problem came. Then what you will do? You have to be present in the exam hall. For that these efforts are. Understood? If really problem solving is important, we can take the question, yeah, bunch of questions you can take. From question number 1, that, if you do now over. It's not about doing the questions, it's all about understanding the concept. I'm very, very specific from the day number 1. So try to understand clearly. This is not about, okay, understanding this question. It is about understanding the concept as a whole. When you see, okay, whenever cash flow comes, our duty is to reinvest back. Reinvest back at what rate? Same rate. Then only you will get that 1 lakh. If you reinvest at a lesser rate or higher rate, this 1 lakh will not come. Clear? So that's what I wanted to tell. Understood the concept clearly? Okay. Now what we will do is, we will see how the annuity cash flow will work. What cash flow? Yeah, annuity cash flow will work. Okay. Now listen carefully. This is about single cash flow. What you have done now. Okay. This also you have copied. Wrong side and right side both you have done. Correct? Once clear everyone? Did you write this part of the notes? Yes. So this note, have you written everyone? This note. Okay. Next. Next. See here. Now real discussion will begin. Listen carefully. Present value equal to future value divided by 1 plus r whole power n. Okay? 1 plus r whole power n. Or PV equal to FV into 1 by 1 plus r whole power n. PV equal to FV into 1 by 1 plus r whole power n. Now the question starts. Present value of a asset dependent on future value cash flows into 1 by 1 plus r whole power n. Future lo you are going to get 1 lakh into 1 by 1.10 power 3. 1 lakh into 1 by 1.331. Yesterday's information I am rewriting into 0.7513. That became 75,130. Listen carefully now. This is the future value. This is a discounting for 3 years. This is 75,130 present value. Which value? Present value. What you have to understand? Present value of 1 lakh which comes after 3 years. I told from the beginning. 1 lakh today. 1 lakh after 3 years will have same value. Different value means different value will be there. Now I will ask you another question. Reverse la. T3, T0. Cash flow of T3, cash flow of T0. 1 lakh. 1 lakh cash flow of T3, 1 lakh cash flow of T0. 1 lakh cash flow of T3 will be lesser than T0 na? More than T0 na? First answer that. T3 cash flow 1 lakh will be lesser than T0, more than T0. Reply. So many participants are there. 70, 75 participants are there. Answer everyone. Okay. So now what you have to understand, though both are 1 lakh, the timing of receipt is different. This is received after 3 years. This is received today itself. Okay. Now you said T3 will have lesser value than T0 1 lakh. Okay. T0 1 lakh. Now I will ask another question. T3 1 lakh is less than T0 1 lakh, you said. Okay. Less than you said. But how much lesser? How much is the value? This value today is 75,131. Understood? Means if you give a person 75,131 today, how much he will feel happy? If you give 1 lakh after 3 years, he will be having the same level of utility. This is called as economics. Okay? The utility of the person is same. You give a person 75,131 today, a level of happiness will come. You give same 75,131 after 3 years and he is unhappy. You should compensate him with 1 lakh. Then only he will be equally happy with 75,131. All the ways possible I am trying to explain here. The economics inside the finance, the normal idea behind the finance. Everyone understood the concept clearly. The utility concept is this time value of money. The person will have the same level of utility. For example, if I am a level of happiness will come if you give me 1 lakh. If you give me 1 lakh, I have a level of happiness. If you give same 1 lakh after 3 years, I will not get the same happiness what I am having today because that 1 lakh is not having this much of utility. Clear? So therefore, try to understand. 3 years after, if you give me 1 lakh, I will get a level of happiness. To make me happy today, you need not give me that 1 lakh. It is enough if you give me 75,131 today. Understood? So that's the idea behind this concept of present value, future value. Okay. So what will happen? After 3 years, if you give me 1 lakh, if a level of happiness will come, I will get the same level of happiness if you compensate me with 75,131 in the today's situation. Understood or not? That's the idea behind this present value. So present value of 1 lakh is not 1 lakh, it is 75,131 only. It is 75,131. Now the question will start. See here. Present value equal to future value divided by 1 plus r whole power n. Okay. So present value equal to future value into 1 by 1 plus r whole power n. Okay. Now let's decode the entire formula now. PV equal to FV divided by 1 plus r whole power n. PV equal to FV into 1 by 1 plus r whole power n. R here represents the rate of return. N represents the time periods. Maybe years sometimes or quarterly also you can take. FV means the future cash flows that you are going to get. How much cash flows you are expecting in future. This is the idea. Now the question will arise. Sir, why we will divide? Present value should be lesser than future value. Therefore, from the future value 1 lakh, we need to deduct some X amount. Such that you will get the present value. I repeat one more time. Future life I get 1 lakh. Present value of this 1 lakh is not 1 lakh. It is 75,131. Means I should deduct some 24,000 some amount in order to get this 75,131. Correct or not? Now the question. Rather than subtracting, why they are doing division is a question now. Correct or not? Why they do the division instead of doing the subtraction? The logic is in mathematics. Okay, in mathematics, multiplication is called as continuous addition. Division is called as continuous subtraction. Sir, I didn't understand. I will give you an example. Okay. 5 4s are 20. 5 4s are 20. Let us understand what does it mean. 5 4s are 20 means how many times, listening, how many times 5 should be added to 5 in order to achieve 20. 5 plus 5 plus 5 plus 5 makes it how much? 20. Multiplication is nothing but how many times you should add? 4 times you should add 5 to 5 in order to achieve 20. Therefore, instead of doing 5 plus 5 plus 5 plus 5, they will write 5 into 4 equal to 20. So, multiplication is continuous addition. Next. So, next one. 25 divided by 5 equal to 25 divided by 5 equal to 5. What does this mean? This means how many times 5 should be subtracted from 25 to make the remainder 0, to bring the value to 0. Means I want end result as 0. Number is what? 25. From this 25, with what you are dividing? 5. Means how many times 5 should be subtracted from 25 to achieve 0 result? 25 minus 5 20, minus 5 15, minus 5 10, minus 5 5, minus 5 0. So how many times you are subtracting it? I am subtracting 5 times. Instead of writing 25 minus 5 minus 5 minus 5 minus 5 minus 5, I will write 25 divided by 5 equal to 5. So instead of doing continuous subtraction, it is enough if you do one time addition, one time division. Same logic. Here 3 years cash flows are there. Instead of reducing every year cash flow from 1 lakh, one time you divide. Division is a continuous subtraction. Actually there is subtraction. Discounting is a subtraction. Discount means what? Reduce. Discounting is a subtraction. But instead of, for example, 10 year data is given. 10 years you will subtract like a fool. So instead of doing 10 years subtraction, you do one time division with the power. That's it. Answer is over. That's what he wanted to tell. My work is over again. Answer everyone understood. Okay. So my point is very clear here. Understand. Division is a continuous subtraction. Okay. Compounding what you will do? FV equal to PV into 1 plus R whole power n. Means what? I will invest 75,131 today at the rate of 1.10, at the rate of 10% for 3 years. Okay. 75,131 into 1.331. So you will get some 1 lakh rupee. In this value also you can do. Here we are calculating FE, future value. From this what you have to understand? I will get interest for the first year, add it, again reinvest, add it, again reinvest, add it. See here. Instead of doing all these things which we have done in the yesterday's class, instead of doing all these things, it is enough if you use this formula. That's why into came. Into is a particularly, if you wanted to understand, it's a continuous addition. Instead of doing continuous addition, do multiplication for one time power law, you keep the respective amount. Answer is over. Okay. So therefore that's the idea behind this particular concept. That's why people go for multiplication and division. That's why always in the finance you will find that multiplication and division, because multiplication is a continuous addition, division is a continuous subtraction. So that's the point here. So that's why the symbol also came like this. One number above, one number below. Okay. Originally we need to use a subtraction. Okay. One number above, one number below. So like that again. Remember one point. Less than, greater than symbols also people are finding difficult. Which is less than, which is greater than. Though they need not tell us always. 6, 8. Which is greater? 8 greater than 6, or 6 is less than 8. 6 is less than 8. Okay. Correct? Next. 8 is 6. How to write? 8 is greater than 6. 8 is greater than 6. Always remember, mouth open will be always on the greater side. Mouth open will be always on the greater side. Here mouth open is on 8. Here mouth open is on 8. Always a symbol is only on the greater side. Understood the point clearly? Clear? So this is the overall idea behind this particular formulas and analysis. Hopefully everyone is clear up to here. right? So see here now, ways of calculating the PV factor. Okay, ways of calculating PV factor. Formula 1 by 1 plus r whole power n. 1 by 1 plus r whole power n. Same, like this you can do. Sir, I don't wanted to do like this much big process I don't wanted to do. Okay, don't do. Go for the table. Book back the tables will be there. In the table you can see for 10% for 3 years how much is the value. Okay, you can do that. No, sir, tables examiner they don't give. Okay, in that case use the calculator directly. Take calculator 1 by 1.10 you type equal to 3 times. Equal to how many times? 3 times if you press. Automatically you will get the answer. Just multiply that, you will get the final result. Understood the point clearly? So please copy down this. And moreover, see here now. Year 10. Year 10. Everyone answer to my question. When I write year 10, 1 to 10, 10th year ending. Tell me first. 1 to 10 or 10th year ending? Ten means 1 to 10 year or 10th year ending? Yes, this is end of year 10 means one cash flow is only coming. If it is 1 to 10 I should write like this. Okay. Next. So 10th year I am getting 50 lakh. 10th year I am getting 50 lakh. Today how much is the value? Okay, today how much is the value? So when I ask today's value of the future amount, you should discount it. You should subtract. Instead of doing 10 times subtraction, do one time division. So how to do? 1 by 1.08 power, how many years? 1 by 1.08 power 10. Use the calculator. 1 divided by 1.08 power 10 equal to, for 10 times you will get one value. That value is 0.463. Just multiply that, you will get 23,15,967. Sir, how to interpret this 23,15,967? So many ways of interpretation are there. I will first tell one interpretation. Economics way of interpreting. How much utility, how much satisfaction I will get, how much happiness I feel. If you give me 50 lakhs after 10 years, equal amount of happiness I will get today if you give me this much. If you give me this much amount. Means the level of happiness what I get today, if you give this much, I will get the same level of happiness if you give me 50 lakhs after 10 years. That is one way. Another two ways are there. If we invest 23 lakh 15,967 today at 8% return, with the intermittent reinvestment at same rate, we get the maturity value of 50 lakh. Or the value of 50 lakhs after 10 years is not same as 50 lakhs today. Okay, the value of 50 lakhs after 10 years is not same as 50 lakhs today. It will be very less in today's term. In short, it will be only 23 lakh 15,967. Okay. So one person asked about difference between PV IFA. IFA means annuity. We will see that once after this is completed. We will see annuity. Please everyone write the basics notes without any fail. Please, because in the hand notes I am not giving this. Hand notes the chapters will start. Please open this, write down properly. Completed writing? Okay. So one student asked the doubt, sir, when calculating the present value, then T0 will be less than T3. T0 will be less than T3. Okay, T0 means a present value of T3. Present value of T3 will be lesser than T3. Okay, don't call it as a T0, call it as a present value of T3. Present value of T3 will be always lesser than future value of T3. Someone asked the doubt, Aishwarya. Hopefully you understood answer. So next one. So now we did with the concept of present value cash flows we completed. We understood. Next one. Keep the heading. Present value of annuity cash flows. Present value of annuity cash flow. This concept is present value of single cash flow. This is present value of annuity cash flow. Okay. First listen carefully. I will explain the concept. Once after I explain the concept, I will give time for you to copy. You can write down. Clear? Okay. First listen carefully. Present value annuity factor. Present value annuity factor. Okay. Now listen carefully. The concept behind this present value annuity factor runs this way. Year cash flow PV at the rate of 10% PVCF. I will be getting three cash flows. Year 1, 1 lakh. Year 2, 1 lakh. Year 3, 1 lakh. So all the 3 years, I will get different amounts, the same amount, but for a limited period. 3 years or 6 years or 10 years or some limited period is there, not perpetual. Same if it takes for unlimited years, we call it perpetual cash flow. It's annuity in a different form. Okay. So what you will write 0.909, 0.826, 0.751, 90,900, 82,600, 75,100. Please tell the total. Everyone, please tell the total. Please tell the total, everyone. Okay. So 2,48,600. So 2,48,600. What is this? 2,48,600 is the present value of all these future cash flows. Okay. Now, instead of doing like this, see here. What they do is year cash flow PV at the rate of 10% PVCF. PV at the rate of 10% PVCF. Okay. Take calculator. 1, 2, 3 they will write. How much? 1 lakh. Take calculator. 1.10. Sorry, 1 divided by 1.10. M plus equal to M plus equal to M plus 3 times and plus MRC. You will get one annuity value. Please tell that value how much it is. 2.486. Multiply 2.486, 2,48,600. That's how you will get this answer. Understood the point or not? So instead of doing this much of exercise, you can just take the total of annuity factors and do it. So this is called as a annuity cash flow. Which cash flow? Annuity cash flow. This is called as present value annuity factor. Present value annuity factor. Now someone asked the question previously. You please reply. Did you understand what is annuity factor? Someone asked the question. Some person. I didn't remember the name. Someone asked the question. Ashok Kumar. Now do you have the clarity? So this is called as a present value annuity factor. Okay. Sir, then what this is, sir? 0.7513 in the previous, this is called as present value factor for 1 year. This is present value annuity factor of 3 years. 3 years annuity factor this is. Okay. Annuity means what we are doing. See here. Please everyone see. 1 lakh into 0.909 plus 1 lakh into 0.826 plus 1 lakh into 0.751. This is what we have done here, correct or not? Okay. Now, mathematics the point is A into B plus, understood? A into B into A into C plus A into D. If it is an equation like this, additive with the multiplicity principle, if the multiplication of the first element is common, you can take it common directly. A into B plus C plus D. This is a logic that applies. Okay. So B plus C plus D. Here how much is the A? A common 1 lakh into, this is into plus A, B plus C plus D. 0.909 plus 0.826 plus 0.751. So 1 lakh into, tell me how much this total is? 2.486. That's how 2,48,600 came. This everyone understood or not? How this concept came? Why 2.486? Everyone reply fast. Okay. So this is the idea behind this particular concept here. So how this concept came in, this is how it came. So there is a formula also for this which I don't follow anywhere, or even institute also will not follow. Annuity factor means directly they will do. But for the concept sake, there is a formula also for this. First see here. This is the situation. You can take like this. But I wanted to tell you one thing. 3 cash flows are there. Can I add these 3? No. Because all the 3 belong to 3 different time frames. One can't add this directly because all these cash flows belong to 3 different time frames. Okay, can I add these? Yes, because this is discounting of 1 year to 0 year. This is discounting of 2nd year to 0 year. This is the discounting of 3rd year to 0 year. All these 3 are present value. Today's value these are. So you can add all these. These cash flows can be added since all these cash flows belong to a common time frame. This is way number 1. Okay, you have to separately write. But I don't recommend this. Not me. Institute also don't recommend this. Okay, there is another model called as directly doing like this. Way 3. 1, 2, 3. 1 lakh. 2.486. We will get the final answer. Okay, but how this concept came? For this is the rule. 1 lakh into 0.909. 1 lakh into 0.826. 1 lakh into 0.751. 1 lakh common, add all these. So this is the cash flow. This is the present value annuity factor. If you multiply in a present value discounted cash flows, you will get. Okay. Way 3 you have already seen. Okay. So what you can do, there are 4 ways of calculating annuity factor. Number 1, formula. What is the formula here? 1 by R. 1 by R. See here. 1 by R. Okay. Into 1 minus 1 plus R whole power n. 1 by R. What is the rate in the given question? 1.10. 1 minus 1 divided by, what is the rate? 1 plus 1.10 power 3. 1 by 1.10 minus 1 by 1.331. Okay, if you do all these calculations you will get this 2.4860. But I don't recommend that formula in any concept. Just there is a formula, just note it down and understand. Or you can take the second way, like this. You have to add this also. I don't recommend 3 times you have to write the same 1 lakh. Table exam they don't give. If they give, okay. Therefore easiest method is what you follow in CA Inter. Take calculator, 1 divided by 1.10, press equal to m plus, equal to m plus, equal to m plus. How many years you want? 3 years. Equal to m plus for 3 years. That's it. MRC, memory recollect, you click, you will get the final annuity factor. Okay, this is the ways of calculating PV of annuity factor. Please copy down the notes clearly. Basics only you have to write the notes. From the next chapter onwards, no need to write, only problems you need to copy. Basics I will not give in the material, so have the full notes clearly. So someone is asking a question, can we use GT button too? We can use GT button, but all calculators might not have GT. But every calculator will have MRC. Memory recollect is more easier than GT. Sir, up to way 2 everyone completed writing? Up to way 2 everyone completed writing? Complete this. Once you complete, we are done with almost everything in the basics. So please write down. Everyone completed writing? Everyone completed writing? So let's continue. So we completed annuity factor as well and understood that if the same cash flow comes from multiple years, you need not calculate all separately as a single cash flow. It is enough if you take an annuity factor. Okay, that's what we saw. Next, multiple uneven cash flow. Multiple uneven means capital budgeting, means we don't know what will happen. 1 year 1 lakh may come, another year 4 lakh may come, another year 3 lakh may come. Randomly the cash flows will come. So now if all the cash flows are same, you can use the annuity factor. But all are different. Now there is no choice. Treat each and every cash flow as a single cash flow. Treat each and every cash flow as a single cash flow. Single cash flow, what is the formula? Future value into 1 plus r whole power n. Correct? Future value is how much? 1 lakh. Coming after how many years? 1 year. Means n place lo 1 year have to keep. Clear? So future value divided by 1.10 power 1. So 1 lakh divided by 1.10. It will become 90,900. Next, 4 lakh you are getting. When you are getting 4 lakh? After 2 years. So therefore this is a second year single cash flow. So therefore how to do? Future value 4 lakh divided by 1.10 power 2. That means each and every cash flow you will treat it as a single cash flow and you will do. Okay, that's how you have done. You got 6,46,600. Understood the point clearly? So please copy down the multiple uneven cash flows. Okay, multiple uneven cash flows. Please copy down. So in this the unique feature is cash flows are multiple but not even. Even means every year 1 lakh. Now it is 1 lakh. Sorry, first it starts with 1 lakh. It went up to 4 lakh. It came to 3 lakh. Like this it will come. Randomly the cash flows are placed. Please write down and complete all the basics. Yeah, once the basics are completed, happily we can start with the main questions and we'll start and complete in no time. Completed everyone? Confirm everyone completed? Okay, let's now begin with the final concept called as perpetual cash flow. So what are the three types of cash flow we came across? Single cash flow, multiple even cash flows also called as an annuity cash flow. Third one is the multiple uneven cash flows. Fourth one will be the perpetual cash flows. I just want one answer from all of you. Okay. Honestly, first put one answer. Everyone who joined live, did you understand all the basics we learned till now? Everyone, did you learn all the basics that were done till now? Understood all the concepts clearly? Okay. So we now completed almost all the basics except two concepts here. Number one, perpetual cash flow we have to understand. Number two, we have to understand is what is the concept of reinvestment. What is the concept of reinvestment? These two things are pending for us. Okay. Once we complete these two topics, okay, irrespective of the time, I will first complete this and then give a break, such that afresh we can start with our 12 marks to 15 marks area called as Forex. Okay. So now then you will understand, okay, what we are actually. You will understand once you start with Forex. Clear? When others are feeling difficulty about understanding the basics of Forex, how we go through the Forex chapter will understand. Okay. You become a gem of a guy when a question comes in the area called as a Forex. First I will do the complete hand notes. Okay. Hand notes like a 60 unique problems taken from the study material, RTP, MTP, etc. Okay. 60 unrepeated questions again. I mean unrepeated. Means one question, another question will not have any repetition. Those kind of 60 questions I kept with 15 basic questions. So technically 45 extremely quality questions I kept. We will do that. Once after doing those, I will also open the latest amended institute study material. Okay, with regard to the Forex chapter, I will open that. Okay, and whatever the questions which are common between our book and the study material, we will tick those. Uncovered problems will be there. Then we will do those in the study material. Beyond this, what humanly I can do? Did you understand the point? Whatever are common questions, 95% common questions will be there, because I don't leave any of the questions from the study material. Even at that time, sir, this illustration or this point was not covered in the book, then we will cover those. I will give the page number and we will do the problems in that way. Such that, okay, you complete all. And I mean, whenever you do my book, you are completing study material RTP, MTP parallelly. Even after that, if you find any in 60 questions, maybe 4 or 5 questions are these are not covered now, those also let us do. Clear? Such that first thing you will cover the institute sources. You will cover institute sources. Recently I took an interview with one of the person who qualified CA final. First attempt he got 5 exemptions out of 6, highest in AFM. Like that I started giving them interviews such that they will know, people will know about the insights of the students. 113 students have got exemption, in that 61 got more than 70s. How come it is possible? So you have to learn about the conceptual clarity on any question. Don't concentrate on solutions. Don't concentrate on problems. Concentrate on concept. If you do like this, it will come. If I don't do like this, what will happen? That also you should know. Then any question that comes in examination, you will be able to crack them. Hopefully you are understanding the point clearly. Right. So the moment we start with the chapter called as a Forex, first we will cover the basics and then we will go into the main concepts. Okay. Let's see. See here now. So perpetual cash flow. What exactly perpetual cash flow means? The term perpetual means there is no end. Like this, you should not think. That's not the meaning. There is an end, but we don't know the end. Okay, we don't know the end. I will give one super duper example here. I started a company. I asked a person, how many years this company will be in existence? Okay, I asked him, how many years this company will be in existence. Okay, how can any person can tell just like that by seeing that? For example, if you take Tata company, 1904 it was incorporated. Even till today it is there. That means even after 125 years, still company is there. Are you understanding? Still after 125 years, still company is there. Some companies started in the last 4-5 years, not there today. Then how can you tell the life of a company? It is unpredictable. Clear? So, when it is unpredictable, how can you tell this is the number of years the company will be in existence? Since we don't know the end, I repeat, since we don't know the end, don't tell the end. I repeat one more time. I asked you, how many years this company will be in existence? You said, I don't know. Okay, then I ask another question. What is the life of this company? You said 20 years. Are you are a muttal or what? You are a fool or what? You only told that you don't know the life. Then how can you confirm 20 years to 25 years to 30 years to 35 years? How can you tell? Mula illana unaka. So, the concept is when you don't know the end, don't tell the end. So, when we don't know the end, we assume that, assumption again, we assume that it never ends. We assume that it never ends. Understood? So, we assume that it never ends. It is an assumption that company never ends. But really, there is an ending. We don't know the end. When you don't know the end, don't tell this is the end. So, when I can't tell where it ends, what I can do? Maximum you will assume that there is no end for that. Understood? There is no end for that. That's what the assumptions we will make. That's why this assumption name is also called as a going concern. That's why fundamental accounting assumptions, one of the assumption along with consistency is business entity concept, going concern concept and consistency. Fundamental accounting assumptions. In that, one of the assumption is going concern. Fundamental accounting assumption. Going concern is assumption. No one can tell when company will end. When you don't know the end, don't tell the end. When you can't tell the end, assume that it never ends. Clear? So this is the point. So when you don't know the end, don't tell the end. When you can't tell the end, assume that it never ends. So that's how this concept of perpetual started. But how practically one can understand this perpetual cash flow? Sir, in real life, is this possible? Yes, in real life, this is absolutely possible. Clear? But how is it possible? Let's understand. Real life implications of real life application of this perpetual cash flow. See here, there are some concepts called as legacy deposits. Legacy deposit means grandfather will be there. Who? Grandfather will be there. Our ancestors will be there. They will deposit 70-80 years back some amount of money in a bank. Okay. They will write a private trust, saying that private trust means within the family. Family trust deed they will write. Anyone with this surname, okay, when they are born in the family, from this account benefit should go to them. Okay, but you can't transfer the amount balance. You can transfer only the interest on that. So beneficial interest only will be there. Ownership will not be there on the amount. For example, a zamindar is there in 1940. He has 100 crores amount at that time. He deposited that in SBI. And he said that whenever money comes, whenever interest comes, this should go to the family members carrying this surname. He wrote a private or a family trust deed and he died. Okay. Till how many years? Perpetually. Till that family legacy continues. The Vamsa Vruksham of that family continues, this person will be paying the money. So those are called as the legacy deposits. Do you know when it is more popular? When it is a temple trust. When it is a temple trust. Classic example, Tirumal Tirupati Devasthanam is having a legacy deposits. Thousands of crores of legacy deposits are there. Why? There is no end for the God. He is the creator, he is the destroyer. So therefore what they thought is, let us deposit money in the name of God. We may be there, we may not be there. We live, we born, we died. But he will be there always. He is a creator. So therefore what they thought, let us put the money in there. He will carry his own deposits. He is the biggest collection king in India. Na? So then put the money in his name. He will be there. He is eternal. He will be there always. You may be there, I may be there, I may not be there. He will take away. But still, God will be there always. Na? In that trust. Okay, what they have done, they created a TTD. Legacy deposits are created. Thousands of crores of amount was deposited. Till when it will be there? Till the God lives. There is no end for the God. So, therefore, in real life also there is concept of perpetual deposits. Okay, what deposits are? Perpetual deposit. However, understanding sake, shall I give you a perpetual concept? Listen. In the context of our subject, which is more popular? Single cash flow, multiple uneven cash flow, perpetual cash flow, or annuity cash flows? Four cash flows are there na? Single, annuity, uneven, perpetual. Which is more popular cash flow in our subject of AFM? Sir, this TTD, all the legacy deposits, very rarely we find, but they are in our subject which is more popularly found, entire subject of AFM. Everyone? Okay. So everyone has given your own answer now. Highly found concept in our entire syllabus. Okay. There are two. Multiple uneven. And next one, perpetual. Yes. These two are very less found in our subject. Single cash flow also found. As annuity is not found anywhere. Very, 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 very rarely, except in the chapter bond valuation, you won't see anywhere. Okay. So bond valuation chapter only has annuity because interest cash flows are always same for every year. Okay. So therefore, mostly we use uneven and perpetual. In that also perpetual is highly found. Sir, really, sir, and in our exam, in our syllabus, is there any legacy deposit? Legacy deposit is an example only. But in reality, how the perpetual cash flows will work? Classic example, share. Share will be there till the company is there. Share will be there till the company is there. I will ask a question. Everyone, please answer this question. How can you tell that if share is not there, company will not be there? Reply. Those who joined live. How can you prove that if share is not there, company will not be there? I said share will be there till the company is there. You prove that or you prove me wrong. Either prove me right or prove me wrong. Waiting for your answer. Okay, sir, I will give you an answer, a straightforward answer. Yesterday we already discussed assets say in the form of share. So there is nothing great like a share. But how can you tell that share will be there till the company is there? I will give you an example. There is a section in Companies Act called as Section 2 Clause 68. There is a section called as Section 2 Clause 71. Section 2 Clause 68 talks about private company. Section 2 Clause 71 talks about public company. Even if you see Section 2 Clause 62, one person company. Section 2 Clause 85, small company. Anywhere in Companies Act, if you see, you will find one concept very clearly. Do you know why? Do you know what? Private company is defined in the Companies Act under Section 2 Clause 68 as follows. Private company means a company which is having minimum paid up share capital. Means you can't become a private company unless and until you have a minimum paid up share capital. Second, public company. Public company means a company which is not a private limited company but has a minimum paid up share capital. Means even in case of public company, without share capital, company cannot be there. Clear or not, everyone? So it should have a minimum paid up share capital. So the concept what you have to understand is private company, public company must have minimum paid up share capital. Without shares, those companies can't get incorporated. If you want to incorporate a company with guarantee and without share capital, start as a Section 8 company. That's why Section 8 company need not use the word limited or private limited at the end of its name. Section number 8, subsection number 1, clause number A. So you need not use. So the point what you have to understand here is, listen carefully. Perpetual deposits, how they will be. Perpetual amounts, how it will be. Let us take in our syllabus a share. Let us take in our syllabus a share is there. Share gives share is perpetual. It will be there till the company is there. What revenue share will give? What cash flow share will give? Dividend cash flow share will give. What cash flow? Dividend cash flow share will give. So till when dividends will come? Till the end of company. Till when share will be there? Till the end of company. When the company will end, I don't know. Therefore, share is perpetual. Cash flows on the shares are also perpetual. Therefore, always dividends are perpetual. So, in our entire syllabus of AFM, share wherever it is there, perpetual cash flow is a concept. But the tragic moment is, in our syllabus, half the concept is covered by shares. Share valuation, equity valuation, business valuation, portfolio management, mutual funds, mergers acquisitions, all these are mostly on the equity only. So therefore, equity will dominate, perpetual cash flows will dominate the entire syllabus. Okay? Now, everyone mind one question will be there. Sir, single cash flow you told PV equal to FE divided by 1 plus R whole power n. Understandable. This is for the single cash flow. Annuity cash flow also present value equal to 1 by R into 1 minus 1 by 1 plus R whole power n, like that you have given, sir. This also we understood. Number 3, multiple uneven ki formula will not be there. Just put on the table random amounts. Use a single cash flow for each and calculate. Understood. Like that, what is the formula for present value of perpetual cash flows is a question now. Okay. So let us understand the concept clearly, sir. This is very, 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 very important for your syllabus. I am telling you very much in advance. Without perpetual cash flow concept, you can't start any of the equity concept. So please listen carefully. See here. I said like this. Okay, I will give you 1 lakh, 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 so on till you live. If you died, your legacy. Like this I will give. Or second option, ask some lump sum amount today. Either go for future 1 lakh, 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 1 lakh every year. For example, your return expected is 10%. Okay, return expected 10%. Now listen carefully. I said this way. I will give you 1 lakh, 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 1 lakh forever till your legacy lives. Okay. Or this is all happens in future. Or another option I will give. What is another option? Lump sum amount I will give you. Okay, you ask some lump sum amount, some bulk amount you ask today itself. I will give. Either ask bulk amount or take 1 lakh, 1 lakh per annum every year. Which one will you choose? Everyone has to reply. Don't sit idle in the class. I said, take 1 lakh, 1 lakh, 1 lakh, 1 lakh forever till your legacy lives. Okay, that's all happens in future. Okay, take bulk today. Which one will you choose? Okay, obviously, people will say lump sum only. People will say lump sum only. Okay, maybe some people may ask 1 lakh also. But most of the people will ask only lump sum. When you say lump sum, you tell me how much lump sum you will ask. How much lump sum you will ask? How much you will ask? 1 crore. Okay. Don't tell technical answer, present value, cash flows, all those. Generally, you tell one rate, amount. Sir, I live for another 60 years minimum. Each year, even if I receive 1 lakh, it will become 60. Like that, you should tell, na? Some amount you tell. How much I should give you as a lump sum amount? ₹100 crore, 50 lakh, 80 lakh. 1 crore, 2 crore, 80 lakhs. Sorry, everyone have that 100 crore. You ask 100 crore, 1000 crore, you ask whatever it may be. But I should give, na? So, because I am Kaushik Mukesh, not Mukesh Ambani. So, you can't ask in hundreds of crores. So, the point is, try to understand clearly. The idea is very clear here. Either take 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh every year till your legacy lives, or take a lump sum amount, I said. You said, okay, sir, I will take lump sum amount because the future is unpredictable, future is unexpected, future we can't predict what will happen, so I will take a lump sum amount. Okay, understandable. Logic is very simple. So I will take everything today itself. Sir, I will take a lump sum amount today, you said. Then I asked, how much lump sum you will take? Some person said 100 crore, 10 crore, 10 lakh, 5 lakh, like that, something they will tell. But the answer is, I will not give you more than 10 lakh. Sir, then I will take 1 lakh every year, sir. You take, both are having same answer. Even if you take 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh forever till you live, or you take lump sum 10 lakhs, both answer is same. Sir, 1 lakh, how it will be same, sir? If I live for 10 years, 10 years I will get that 10 lakhs. I will live at least for another 50 years, sir. 50 into 1 lakh, 50 lakhs I will get. At least I will ask that amount. Now, how you are telling 10 lakh? 1 lakh, 1 lakh, 1 lakh, 1 lakh if you take, I will tell you one question. Use calculator and tell me. Everyone should use calculator and tell me. 1 by 1.10 power 20. 20th year ki, what is the PE factor, you tell me? 10% interest ki. You are expecting 10%, na? So, 20th year. And equal to 20 times you need to present tell. Tell the factor value. I want every one of you participate, use the calculator. 1 by 1.10 power 20. Okay, how much? 0.149. 0.149. Okay. Understood. Listen. 0.149. What is the meaning of this 149? 0.149. What is the meaning? Do you know what is the meaning of this 0.149? Listen. A 1 rupee received after 20 years. A 1 rupee received after 20 years will have 0.149 value today. Ante 1 rupee if you receive after 20 years. Okay. 1 rupee if you receive after 20 years. What happiness you will get? If you receive 0.515 paisa if you receive, that much happiness you will get. Clear? So, the value of 1 rupee today, which I receive 20 years after, is 0.149 only. 1 rupee ki 149 means, okay, 1 rupee 149 means 1 lakh if you receive after 20 years, what will be the value? It is only 14,900. Are you understanding or not? So it is only how much? 14,900. Yeah, that amount value today. So you are thinking, I will receive 1 lakh, 1 lakh, 1 lakh, 1 lakh every year. You are receiving 1 lakh, 1 lakh every year, no doubt. But first 1 lakh you will receive after 1 year. Second 1 lakh you will receive after 2 years. After 2 years 1 lakh, today it will not have 1 lakh value. It will have lesser than 1 lakh value. So therefore, on that basis if you see, I will receive 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh forever till you live. Or ask a lump sum amount. There is a formula. I will also prove the formula. Present value of perpetual cash flows equal to cash flows, future cash flows per annum divided by required rate. Every year how much you said you will give? 1 lakh. What is my required return? 10%. 1 lakh divided by 10% will be 10 lakh. So, the present value of this perpetual 1 lakh is 10 lakh. Sir, prove, sir. I will prove. Lump sum amount you take. How much lump sum amount I said I will give? 10 lakh. Take that 10 lakh. Deposit in a bank at 10% perpetually. Okay, deposit in a bank at 10% perpetually. Legacy deposit you make. Tell me, how much lump sum amount I have given you? 10 lakh. Go to the bank. Deposit in the bank. Give to the banker. Okay, at 10% perpetually. Okay, now tell me, first year how much you will get? Interest. 1 lakh. Second year, 1 lakh. third year 1 lakh, fourth year 1 lakh, 50th year 1 lakh, 60th year 1 lakh. That's what I told you. The worth of 10 lakhs today is equal to 1 lakh every year. Now you reply everyone. Understood everyone? So if you put the money in a bank worth 10 lakhs, on the 10 lakhs you will be getting 1 lakh. Next year 1 lakh, the next year 1 lakh, the next year 1 lakh. 20 years after also you will get the same 1 lakh. Okay. For example, if you put in a FD, if you put in a FD, FDs you will put, what will happen? 20 years FD you open or 10 years FD you open. 10 years after what you will do? Withdraw and reinvest again. Again it will continue. Means perpetually you are continuing it. Though bank may allow, may not allow perpetual. Are you understanding? So therefore what will happen here? How to prove that 10 lakhs lump sum today is equal to 1 lakh every year? Take 10 lakh lump sum amount today. Deposit in a bank at your 10% rate. Okay, deposit in the bank at 10% rate. 10 lakh rupees you kept in the bank FD. 10% return they will give. First year how much you will get? 10 lakhs into 10%, 1 lakh. Next year 1 lakh, next year 1 lakh, next year 1 lakh. Like that 1 lakh, 1 lakh, 1 lakh, 1 lakh every year you will get. Correct or not? So now what will happen? That's what we are telling. Randomly placed or continuous 1 lakhs is equal to lump sum 10 lakhs. Are you understanding the point or not? Okay. Now you may get a doubt. You may get a doubt, sir. I will go for lump sum only, sir. Lump sum is much better because in a lump sum, I am having my 10 lakhs anyway with me. Along with that, I am getting extra 1 lakh. You are wrong because the moment you are compromising means the moment you are losing that 10 lakhs cash, then only you will get that 1 lakh rupee money. Simply to tell, you will get 1 lakh interest when you are keeping that 10 lakhs in the bank. Means it is of no use for you now. You can't use that 10 lakh. The moment you withdraw 10 lakh, this 1 lakh will stop coming. So therefore, always try to understand clearly. Whenever a question comes on perpetual, what is the formula? Present value of perpetual cash flow equal to cash flow per annum divided by R. R means required rate. Okay. On this basis only, if you observe value of a share P naught equal to D by KE, they will write. Or if it is a growth, D1 by KE minus G. What does it mean? D, dividend perpetual, that is cash flow per annum. KE, required rate. Answer over. That's how the pricing of a share came. Everyone understood? Reply. Okay. Write down this. Please copy down. Completed writing the notes? Everyone completed? Clear everyone? Completed writing the notes? Yeah. So we now completed all the basics of cash flows concepts as well. Okay. So this is a summary diagram to show how the PV factors will work. If you see the diagram, compounding is a concept where present value will be taken to future. Discounting is a concept where future value will be taken to present. That's it. Okay. Just for diagram sake, not for writing. Okay. See here. Write down this special illustration, everyone. Copy down. Illustration on reinvestment concept, single cash flow. Keep the heading. Illustration on reinvestment concept, single cash flow. Question only, heading only you copy down. Okay. Have you copied the question, everyone? Everyone copied the question? Okay, see here now. Last segment in our basics. Listen. See here. A person wanted to get, listen carefully, sir. This is the last segment in our basics. Okay, last segment in the basics. Let's see the question first. A person wanted to invest today. Zero means today. Some X amount. He don't know how much. His return expected is 12%. His time available is 5 years. He wanted to make this X amount into 10 lakh. Okay. Over a period of how many years? 5 years. So again I repeat. A person wanted to invest some X amount today for a period of 5 years with a rate of return of 12% intermittently for 5 years, for which he will be getting 10 lakh rupees after 5 years. How much I need to invest today, he asked us. Okay. First everyone reply properly. This is present value of future cash flow. So future value of present cash flow, sir. Simply we need to discount or compound. Tell me. We need to discount or we need to compound? We need to discount or we need to compound? So we need to discount it. So tell me, how much I will invest today? Some X amount. So present value, everyone, you can write down now. You can write down. Present value equal to future value divided by 1 plus R whole power n. Future value equal to 10 lakh divided by 1 plus R 0.12 power 5. 10 lakh divided by 1.12 power 5, that equal to rupees 5,67,427. Some students have already answered, some have already answered it. 5,67,427. Sir, everyone has got the same answer or not? Please confirm once. Have you got the same answer? 5,67,427. Yes, 5,67,537. That small 100 rupee, 200 rupee difference will come because of PV factors we take. Okay, that you leave off. Last 2-3 digits difference, don't take it so seriously. Okay, because it comes because of approximating the decimals. Sir, okay. So you got 567, 427. 567, 427. First listen carefully. Okay, first listen carefully. Please, everyone listen to me carefully. Listen. I will invest 567, 427 in the 0 year. First year end, okay, interest will come, revised principal. Okay, tell me, how much interest? 12%. Everyone listening to the live, please tell me one thing. 567, 427 on this, interest will be paid at the rate of how much percent? 12%. So tell me the answer, what is 12%? 567, 427 or something, some amount came na? How much I got? 567, 537, okay. 567, 537 you take. Answers will be similar, that's why, not to have confusion. That 100 rupees also, let's make it same. Everyone answer. 567, 537 into 12%. How much you got, Cma? 68,000. Okay, here I got 68,104. Because 567, 537 into 68 into 12% they calculated. 68,091 you got approximately. Okay, some small differences will come, don't take it so seriously. Okay, 68,104 you got. So please everyone listen carefully from now. 68,104 you got as an answer. Okay, now tell me, 68,104 we received today na, after 1 year? After 1 year. Okay, now you tell me the answer, I will listen. Okay, listen, you tell me the answer. Next year, ante year number 1. So this is a 0 year. Now this is year 1. Year 1, our principal amount will be 567, 537 or more than 567, 537. Means interest will be paid at 567, 537 or interest will be paid on 567, 537 plus 68,104. What is this total here? What is this total? 567, 537 plus 68,104. 635, 641. Okay. So next year 635, 641 on that interest. Tell me. $635, 641 into 12%. 76,276. What is the revised principal? What is the revised principal? 635, 641 plus 76,276. 711, 918. Okay. Now everyone stop doing. I will ask one very interesting question. Answer. 711, 918 you got. Okay. Now please stop doing. Stop working. Everyone stop working. I have one very interesting question. Now please answer to the question first. Okay. Later you do all other things. We invested 567, 537 today. Bank will pay 68,104. 68,104. Revised principal came. Now you answer. Every year bank will pay 68,104, 68,104, 68,104 for all the 5 years. Bank will pay 68,104. Every year it will change. Bank will pay only 68,104 every year. It will change every year. Now you answer. bank will pay same 68,104, it will change. Every year it will change. Every year it will change. So first year bank will pay you 68,104. Next year bank will pay you 76,276. 76,276. Like that it will pay. So bank will not pay you 68,104 every year. Bank will pay you more than 68,104. Yes or no? Answer is no. Bank will pay only 68,104. Banks always pay simple interest. They don't pay compounding. Sir, you only said, sir, PV factor. I said PV factor assumes reinvestment. Banks don't reinvest for you. It will not change. Every year same 68,104 will be there in real life. If you invest a principal, for example, FD you take, you made an FD of 567, 537. They will pay interest of 68,104, 68,104, 68,104. Like that only they will pay. Sir, then what to do, sir? That's why I told you. Listen carefully. Reinvestment is your headache, not the bank's headache. It is the headache of the investor to reinvest the amounts back in the same value. Banks don't do that. Okay? So listen carefully first. First listen carefully. Previous example of what you saw, 75,131 deposited. First year interest came. That interest is reinvested back at the same rate. That reinvestment you have done, not the bank. You have to reinvest. That's the difficulty started. Banks don't reinvest for you. Bank will pay the interest. That's it. When the interest is credited to your account, bank will feel that that interest is the amount given to you. They don't pay interest on interest again. So, the point what you have to understand is, okay, the point what you have to understand is, reinvestment is not at the headache of the banker. Reinvestment is at the headache of the investor. For example, you deposited in FD. When the FD rates are 7%, RBI reduced the rates of FD to 6%. From the next month or next year onwards, bank will start paying the interest at the rate of 6 only. But to get that 1 lakh, you should reinvest back at 7. So you should reinvest. Bank will not reinvest for you. Clear? From this, what you have to understand? See, the reality of reinvestment you are going to see now. Don't check anywhere. First see the document what I am writing. Okay? So listen. Year, cash flow, balance years, reinvestment, amount maturity value. Year 1, 2, 3, 4, 5. Okay? Every year I will get how much? 68,104, 68,104, 68,104, 68,104, 68,104. Last year, along with the 68,104, I will also receive my principal back. How much principal I invested here? 5,67,000. Let me calculate and tell. 567, 537 principal will come back along with the principal of 68,104. Last year I will get 6,35,641. 6,38,641. Now everyone in the class answer to the question. 68,104, this one, wherever I made a tick mark. This is 68,104, I will receive today after 1 year. That I will receive today or after 1 year. After 1 year. My total time period is how many years? 5 years. This is coming after when? 1 year. Means how many years I can reinvest it? 4 years. So I can reinvest only for 4 years. So now how to understand? This 68,104 I can invest for the balance of 4 years. So therefore 4 years balance. This is 68,194, 3 years reinvestment, 2 years reinvestment, 1 year reinvestment. You can't reinvest the last year cash flow. In this situation, okay? Now you tell me, I am investing 68,104. At what rate? Same rate of 12%. For how many years? 4 years. Now we are calculating future value because you wanted to know how much this amount will come after 5 years. Okay. So now 68,104 68,104 into it comes to 1,17,163. 1,07,163. Is the screen visible now? Now is it visible? Wait a minute here. Now is it visible? Now is it visible? Okay. I think some pencil issue has come. The screen issue. Now rectified. Okay. Now listen. 68,104 is a first year cash flow. This cash flow, you have an opportunity to reinvest only for how many years? 4 years. So after reinvesting for 4 years, that amount comes to 1,07,163. 1,07,163. If you reinvest at what rate? 12% rate. See here, I will show you. 1,07,163. From here, I will not do, I will just to show you the document. Okay. See here, what will happen. Everyone, concentrate. See here. 68,104 I received. When? Today. After 1 year. I will reinvest it for 4 years. Such that after 4 years it will become 1,07,163. Second year I will get again 68,104. Bank will not reinvest. Bank pays you on the principal. Simple interest. 68,104. Balance years is how much? 3. So on the balance year they will pay again. Are you understanding? So on the balance years you can make reinvestment for 3 years. It became 95,681. This is maturity value at the end of 5th year. This is the value invested at the end of 1st year. Okay, it means 4 years you made investment. 3rd year again bank will pay. Reinvest for 2 years. That amount will become 85,430. 4th year again you got 1 year reinvest. 68,104 becomes 76,276. Last year 6,35,641 you will receive. No reinvestment. That renders 6,35,641. Now if you total, that will be equal to 10 lakhs. That's the meaning of reinvestment. You should do the reinvestment. Banks will not do for you. Do you understand the concept or not, everyone? Please tell me. Do you understand the concept, everyone? Say yes or no. Understood? Okay. So the point what I wanted to confirm is whenever reinvestment is made, see here, 68,104 I will receive. I will repeat one last time. Okay. See here. Previous example, just a summary I explain. You invest 75,131 today. You invest 75,131 today. and next year you will receive dividend at the interest of 7513, add it, again reinvest, like that I said. Yes, that example will give impression as if the banker only will reinvest for you. No, they will not. Okay, they will not. Do you know how interests are calculated every year by the bank? Outstanding balance they will take minus interest of the previous quarter, they will delete, and then they will calculate interest. Means interest on interest banks won't pay. Banks pay on outstanding balances. Are you understanding? Bank will pay average outstanding balance, they will calculate. Sir, for example, if you tell I will pay interest on last date, means intentionally some people will bring loan and give 50 lakh rupees. 50 lakh means the interest bank has to pay. They don't do like that. Banks don't pay on lowest amount. Banks don't pay on highest amount balance. Banks don't pay on last day balance, first day balance. No, none of these are right answers. Bank will pay interest on the basis of average outstanding balance. Okay, minus interest payment. Means the last quarter interest is paid. First they will calculate average outstanding balance. In that interest they will delete. Balance amount will come on that simple interest again they will pay. Means they will pay the interest on average outstanding balance minus already the interest is paid. Means compounding interest banks don't pay. Banks pay simple interest. Clear or not, everyone? Reply, everyone. Clear? Okay. So therefore, first year I will receive 68,104. I will reinvest it for 4 years. I will reinvest it for 4 years. Therefore, it will become how much? 1,07,163. When after 5 years, 5th year ending, then only you will get the 10 lakh. Bank don't pay you compounding. Bank will promptly pay you the interest. Your headache is to reinvest it at 12%. Reinvest it at 12%. Listen, how much bank given you in this case? 12%. At what rate you invested? 12%. Bank gave you 12%. Reinvestment also made it 12%. That's why your net return will be 12%. See here. Year 0, you invested 567, 537. 5th year, you got 10 lakhs. What is the formula? FE equal to PV into 1 plus R whole power n. Multiply if it is FE. FE 10 lakh. PV this one. When you calculate, how to calculate the 5th root, I will tell you later, not now. Okay? It's a 5th root of 1.762. 1 plus R equal to 12. 12% you got. Why you got 12%? Because what is the rate at which bank is giving you interest? 12. At what rate you are reinvesting back? 12. Since you are reinvesting at the same rate, what you realize is the same rate again. Now question will come. What is the question that will come? Sir, bank will pay me 12% interest. For example, today I am making FD. At the time I am making FD, rate is 12%. But after I made my investment, RBI hiked the rates of interest. It became 14%. It became 14. Bank will pay me 12 only. Bank will pay me 12 because agreement date ki 12% is there. Bank will pay me 12%. Market la rates of interest increased to 14. Means first year when I receive this 68,104 and when I go for reinvestment, I will not reinvest at 12, I will reinvest at 14. Means bank giving me 12, reinvestment is made at 14. My 10 lakhs will not be 10, it will be more than 10 lakhs because reinvestment is made at a higher rate. Understood the point, everyone? Everyone understood the point clearly? Reply, sir. All the participants, don't sit idle. I can't move forward if you sit idle. Okay. Now listen. So that also let us see. If I reinvest at 14%, what will happen? Bank will pay 68. Balance years is same. I will reinvest at 14. In that case, I will not just get 10 lakh, I will get 10 lakh 17,712. Okay? 10 lakh 17,712. One person already asked it out. If bank pays simple interest, how it will reach 10 lakh? That's why bank will not give you simple compounding. Bank uses simple interest to reach the 10%. That's why don't believe in the words of mutual funds and banks. Bank will tell we are giving 10% return. Means what? That's a return, not interest. Return means what? You have to reinvest. Then only that will give a return. So whenever bank says we are giving a return of 10, it means interest is lesser than 10. Interest payment will be somewhere around 8.2, 8.3. If you reinvest every year, then it will go to 10. That's your care that will be taken. So now I am reinvesting at 14. Now I am reinvesting at a rate better than what the bank gave me. My realization will be more. If you want it in a percentage terms, see here. I invested this much, future I got this much. If I calculate, my realized return is not 12, my realized return is 12.4. Clear? Do you know how it should be understood? See here. I taught you one concept. Okay. You did not do any revision. I told you 4 hours lecture I have taken. You did not do any revision. Then what you will remember is less than what I taught. Reinvestment is 0 then. Okay. I said something. You revised actually what I said. For example, 4 hours class completed. You did all the points what I said in that 4 hours, you revised. Means your revision is actually like my original. Then you will realize what I said. Third, I said you one point. You did revision of entire thing what I said and extra 2 books you read. Now your realized return will be more than what I gave you. Do you understand the point or not, everyone? So reinvestment is like a revision from your side. If you don't do the revision, you won't remember what I said. Understood? Like that bank also will give money, but that money will not be there with you until and unless you make a proper reinvestment. Understood the point clearly? So this is the main concept that I wanted to explain. So if you reinvest at 14, the 12% interest, then your realized return will be 12.4. Sir, but how to calculate fifth root? All those things we will see in a separate chapter called as second chapter in our syllabus, in our classes, security valuation. At that time I will tell you how to do that. As of now, first take the numbers only. Okay, understand the numbers. Next, maturity value, if reinvested 12%, I gave 12, you revised 12. What you realize will be 12. I gave 12, you reinvested 14. Your realized will be 12.4. Listening. I gave you 12, you reinvested at 10. I gave you 12, you reinvested at 10. I did not do that. Just for homework sake, if you wanted to do, you can do, yeah. Oh, I have done now. Okay. But 10% you will reinvest. Then how much you will get? You will get lesser than what I have given. So it will be only 11.62%. In the final outset, everyone tell me, have you really understood whatever the concept I discussed till now? Everyone. Everyone. Say yes or no, understood or not? Okay. Now listen. This notes is already there in the notes I am giving. So no need to copy this particular part. This reinvestment concept I already kept in the notes. So listen carefully. Everyone, one final question before we take a break. Okay, one final question before we take a break. But I want response from everyone participating. Listen, my question. Previously I asked you one question. What is that? 1 lakh forever is better at a 10% rate. Forever is better, or 10 lakh lump sum is better today. So future you are receiving 1 lakh every year, or lump sum amount today only you will receive. Which is better, I asked. Then you said both will be same. at a 10% rate, either 10% or either 1 lakh or 10 lakh, everything is same. That we understood. Now I will change my question, listen carefully. My question is, I will give you 1 rupee, 1 rupee, 1 rupee for 3 years, or I will give you 3 rupees lump sum at the end of third year. Which one will you choose? I will give you 1 rupee, 1 rupee, 1 rupee every year, or 3 rupee lump sum at the end of third year. Which one will you choose? Everyone give your answer. 3 ones or lump sum 3? Why every year? Everyone is answering every year, every year. Why every year? Everyone is answering 1 rupee every year. Na? Why? Why not lump sum 3? Okay. Reason. Most of them said that uncertainty reduces, etc. That's technical way. Normal person should understand when you say something. Okay. The reason shall I tell you? Reinvestment is possible if you receive. Listen carefully. Your time period is 3 years. First year if you receive. Sir, for example, listen carefully. I said you will receive 1 rupee first year, 1 rupee second year, 1 rupee third year. Okay. You don't reinvest at all. Even without reinvestment, after 3 years, how much it will be? 3 rupees. Even without reinvestment, it is 3 rupee. You are telling, I will give you 1 rupee, 1 rupee, 1 rupee every year, or 3 rupees at the end of third year. You said this is correct. Don't choose this. Answer is right. Do you know why? Even without reinvestment, it is 3. Even without reinvestment, both are same. But if you reinvest this at least 1% rate, this will be more than 3. Therefore, that reinvestment will always give an extreme and extra edge to the investor. So, now everyone understood reinvestment concept or not? That's the magic of reinvestment. Which is good? Receiving rupees 3 at the end of third year or receiving 1 rupee for 3 years? Receiving 1 rupee consistently for 3 years is more recommended because 1 rupee at the end of every year can be reinvested at the rate of return, and it is obviously more than 3 at the end of third year. Everyone reply understood or not? All the basics. All the basics. Everyone understood or not? Okay. With this, we completed our unit 0, the basics called as the basics of finance. Okay. With this, we completed all the basics of finance. This notes will be there in your hand notes that I give you, and again PDF also I will share, not a problem for me. So the thing I wanted to confirm you before we start with the next chapter, listen carefully. We completed the basics of finance. Okay, the basics of finance is over. In this outset we are going to cover the entire AFM. Clear? So one by one point after another we are going to deal, and we need to complete it. Clear everyone in the class? Okay. Now, this is the end of our Unit 1 discussion in our AFM EOB. So, listen carefully. With this, we completed all kinds of basics. So, these basics are applicable for EOB, regular, whatever you call. Because I did not go any fast. Because I am very specific about the basic clarity. If student know the basics clearly, problems can be solved in no time. So, I fervently believe that. So therefore, whether regular or EOB, these only I will keep also in the regular with regard to the basics, because this much basic discussion is required. So 9 hours to 10 hours we discussed only on the basics of finance. Once you understand these, chapters will become just like a cakewalk. Clear everyone? So with this, I am stopping this particular area called as basics and time value of money in finance. Basics and time value of money in finance. After the break, we are going to start with our first unit called as foreign exchange, also called as a forex concept. We are going to start. Take a break and come. So let us begin. Just in a minute, we'll start. Am I audible and visible? Am I audible and visible, everyone? Yeah. So let's begin. Okay. So we are now going to start with our first unit in the first chapter in the Advanced Financial Management exam oriented fast track batch. The first unit we are going to start is the foreign exchange risk management. Foreign exchange risk management, also called as a Forex risk management concept. Okay. So the name of the chapter is foreign exchange risk management. Main concept behind this foreign exchange risk management. So before we start with, let me give you some outset regarding this particular area called as foreign exchange risk management. Okay. So the name of the chapter we are going to start is foreign exchange exposure and foreign exchange risk management. So what are these two? Foreign exchange exposure means whenever you make an export, whenever you make an import, whenever you make an export, whenever you make an import. Imports and exports will always leave an exposure. Exposure means a dangering situation to the company. Means company is exposed to a risk called as a currency risk. Called as what risk here? Currency risk. Because of that exposure, there is a risk called as a currency risk. Called as what risk here? Currency risk. Okay. Now listen carefully to the point. Whenever something is exposed openly to something, it will affect us. Not to affect us, we will cover ourselves with something. Are you understanding or not? Say for example, sunlight should not fall directly. We are exposed. Body should not be exposed directly to the sunlight. People wear clothes or some other things or any other substances they apply just to protect. Same concept. Companies are now exposed to a risk called as a currency risk. Whenever they make exports, whenever they make import, receivables is not in rupee, payables is not in rupee, those two are not in rupee terms, those two are in the foreign currency terms. Simply to tell, they may be denominated in dollars, pounds, euros, yens, yuans, ringgits, kroners, okay, or what guilders, whatever the currency you say, different currencies are in circulation throughout the world. In those currencies, they will transact them. Are you understanding the point? So the risk, the company is exposed to a type of risk called as currency risk. What risk here? Currency risk. Currency risk means what? A risk that comes from, okay, a risk that comes from fluctuation in the foreign currency. Fluctuation in foreign currency. Okay. What to do? Cover the company. Cover the company. Really, I am talking. Cover the company. Cover the company with what? Clothes. Cover the company with, okay, cover the company with hedging. Cover the company with hedging. The coat what company will wear to protect against the currency risk is called as a hedge documents or hedge instruments. About that we are going to discuss in depth in this particular chapter. This chapter will account for around, okay, this chapter will account for on an average minimum 8 marks, maximum can go even up to 15 marks sometimes, but 8 pakka, 12 will be generally happening, 15 is the maximum amount. But a good amount of questions will come from this chapter called as foreign exchange risk and exposure management. Foreign exchange exposure and risk management. Okay. once exposure to foreign exchange is there, risk will start. That we are going to manage. Why we call as a manage? We are not going to control it. Foreign currency going up or going down, you can't control them. You can't reduce them. You can only manage them. You can only mitigate them. Are you understand the point or not? You can only mitigate it. Mitigate means what? You can't stop it. You can only stop you getting affected by it. You can't stop its occurrence. You can only stop it getting you affected. Are you understanding the point or not? Okay. Sir, no one can stop the sunlight. No one can stop the dangers of that sunlight. But we can get rid of all those things by taking some precautionary measures. No one can stop the sun. They will be there. Foreign currency also same. Foreign currency changes no one can stop. Foreign currency changes will be there. Maximum what I can do, I will stand and take some necessary measures wherein I will not get badly affected by that foreign currency fluctuations. So therefore try to understand this chapter, foreign exchange exposure and risk management, concentrates from the beginning till the end about the concept of payments, receipts, either in the form of export import or in the form of funding in the form of loans. Okay, so therefore try to understand the concept clearly one more time. This concept of foreign exchange exposure and risk management, this chapter deals with different varieties of transactions in foreign exchange, understanding how to mitigate the risk in the foreign exchange. Understood the point clearly? So, name of the chapter, foreign exchange exposure and risk management. So, two things. First, we will see how we can get exposed to the risk. Next one, managing that risk. Exposure gives you risk. Managing that risk will become risk management. Clear everyone? So, about that we are going to discuss in this entire chapter. Okay. See here. Study material is having totally 108 pages. This is the latest study material I downloaded. Okay. See. They have given some illustrations. They have given some what? Illustrations. In the class, we will do the illustrations and book back questions also I will show you. Let me show you this way. See. From here questions started. Correct? Practical questions started from here. How many practical questions are there? 51 questions are there. How many? 51. In this 51, in the study material, in this 51, okay, in this 51, they covered Forex chapter, they cover currency options, they covered currency futures, they covered currency swaps. These many they covered and gave 51 questions. Okay. In my material, what I did is, Forex is one chapter for us in our classes. Currency options and currency futures is one aspect. Currency swaps is another aspect. Totally put together, we will do 97 questions totally. Okay. So totally we will do 97 questions in all put together. Where institute has given 51 questions, means from where the remaining questions might have come, those remaining 40 questions or something like that. Those remaining 45 questions taken from RTP, MTPs, etc. Clear? So do our folder properly. First to do that. Sir, completed, sir. Everything I completed from the material. Then you do the question banker, whatever the case may be. Okay? Whichever question bank you follow. Whoever the person is, whichever the question bank you follow that. First to do the material what I give you, which contains a study material, RTP, MTP, everything. Okay? But repetitive questions I don't put. Those repetitions, everything you will find in the question bank. Sir, for practice sake, after doing this, I wanted to do extra. Then go and do the question bank as well. Clear everyone? Clear everyone? So let us now start with the Forex chapter. Okay, let's start with the Forex chapter. I will share this document with you. Okay, in the group only I will share this document. Today anyway this document the no need. Next session onwards it will be needed till you receive the books in another 2 or 3 days. So first, these are all the basics that you require to know. Okay, first open your notes, keep the heading Forex. Okay, I will use the word international financial management for understanding sake in my textbook, but from the institute point of view, if you wanted to write down foreign exchange exposure and risk management. Foreign exchange exposure and risk management are the name of this chapter. Okay, foreign exchange exposure and risk management. Okay, before we start with, I just wanted to confirm and tell you one important observation of this chapter. See here. So, this is the name of the chapter, Foreign Exchange Exposure and Risk Management. This is a working notes document for me. What I will do is, after doing the entire working notes for this chapter, okay, after doing entire working notes for this chapter, I will share this working notes also in my Telegram group. Okay, this is a rough working note. Okay, this is a rough working note, but I will write it in a correct way. All the problem, what I promised you, we will do all the problems in the class. Entire hand notes la problems we will do. Okay, but here I will just sometimes I will scribble the answers rather than writing it very clearly, because anyway in the hand notes you are having a full answer. Okay, like a working notes I will again scribble on this particular document, and this document also I will share. Okay, first, from now this is not required. First let us see this. Keep the heading Basics in Forex. Basics in Forex. Basics in Forex. Basics in Forex. So for the Forex, this is a day 1. Okay, for the Forex, this is the day 1. Okay, first everyone in the class, shall we start? Are you ready everyone? We are starting with the most important and difficult area first. Please everyone, confirm. Shall we begin? Okay. First listen carefully, as I already said. This chapter is concentrating on foreign exchange exposure and risk management. Whenever there is a company which is doing any kind of import or an export, for an import there is a exposure of payable. For export there is a exposure of receivable. Import, if it is, you are have to pay, so you are having a payable exposure. For export you are having a receivable exposure. In both the cases there is a risk. When you import you have to pay in dollars, raise in the foreign currency is the risk. Okay, when you export you have to receive money, fall in the foreign exchange is the risk. So risk is there everywhere. Whether you make an export or whether you make an import, once the company is exposed to the foreign exchange, necessarily there will be a risk. So how to mitigate that and manage that risk is the subject matter of this particular chapter. Okay, first let us understand one by one the questions. Keep the heading types of markets. Types of market. Right now, there are three types of markets. Number one, there are three types of market. Okay, there are three types of market. Capital markets, money markets, currency markets. Cash market, money market, currency market. Sir, what is a capital market? Cash market or capital market? Anything is okay. Capital markets. Place where stocks are bought or sold. Money market. Place where money is bought or sold. Sir, money bought or sold means what, sir? Money will not be bought. Okay, money will be bought or sold. Buying money is called as borrow. Selling money is called as lending. Banking market is also called as a money market. There is another market, unique market called as currency market. A place where foreign currencies are bought or sold. Don't write just currencies, but to be very specific, foreign currencies. Because rupee currency in India is traded in money market, not in currency market. Understood? So currency market is a place where foreign currencies are bought or sold. First point, everyone reply. Have you written? Up to here, have you written and completed, everyone? If you give a proper reply, we will be moving on to the next one. Okay. Next. So we completed basics la first question. What are the various types of market? Explain in detail. Okay. If you want to see the main material also, I will show you. Just a minute. See here. First one is the capital markets, also called as the stock market. A place where the stocks or securities are bought or sold. Money market, place where the money is bought and sold. Bought means borrowed, sold means deposit. Okay, invest. Currency market, place where foreign currencies are bought and sold. Okay, one question completed. Next, second one. What are the various types of foreign exchange quotes? Right now. Second one. Various foreign exchange quotes. Branch it into two. One is a direct quote, another one is a indirect quote. Okay. So repeat again. What are the two types of foreign exchange quotes? Direct quote, indirect quote. Again I repeat. There are three types of markets. Capital markets, money market, currency market. Capital markets is a place where the stocks, the securities are bought and sold. Money markets is a place where money is bought and sold, means borrowed or lent. Next, currency market is a place where foreign currencies are bought and sold. Next one, various forex quotes. There are two types of foreign exchange quotations. One is a direct quotation, another one is a indirect quotation. Meaning we will understand one by one. Okay. So what is the second question? What are the various foreign exchange quotations? Completed. What is the third one? What is a direct quote? Explain it with an example. Okay. Keep the heading. Number 3. Direct quote and example. Okay, first write down. Make 2 branches. I will give summary only here. Okay. Anyway, main notes is an explanation, no compromise. Writing, I will summarize and give you. You can just write down. Okay. First write down concept, example, example. Okay. See, concept. Okay. Let's write down. Number of units of home currency for 1 unit of foreign currency. Number of units of home currency for 1 unit of foreign currency is called as what code? Direct code. Sir, I did not understand. Okay. Whenever I say number of units of home currency, there is a home currency that is involved. Okay, for 1 unit of foreign currency means another currency is involved. Expression of one currency against another currency is called as a foreign exchange quotation. I repeat, expression of one currency against another currency is called as a foreign exchange quotation. And x equal to some y, some amount of x is equal to some y, or 1 unit of x is equal to some units of y. That means the two currencies will be equated. So it is an expression of, telling the relationship between two currencies is called as a quotation. 1 pen equal to 10,000 rupees. 1 apple pencil equal to 10,000 rupees. Now what? Two things are expressed now. Okay. To buy this pen, you need to spend 10,000 rupees. Here 10,000 rupees, when I say it's a plural. 1 rupee 10,000 times. Number of units of 1 rupee for 1 pen. To buy this 1 pen, I need to spend how many 1 rupees? 10,000 1 rupees you should spend. Means number of units of rupees you need to spend to buy 1 pen. Now pen place a dollar you keep. $1 equal to 84 rupees. Means what? You need to spend 84 1 rupees in order to buy this $1. Means number of units of rupee to buy 1 unit of dollar. That's called as a direct quote. Direct quote means to buy a dollar, how many rupees I need to spend. Example, $1 equal to rupees 84. 1 pound equal to rupees 102. 1 euro is equal to rupees 91. Okay, rupees 91. These all are expressed in direct quotation. Means what is happening here? Let us take $1 equal to rupees 84. Number of units of home currency for 1 unit of foreign currency. This is called as a direct quotation on dollar against rupee. Direct quotation on dollar against rupee in India. Okay, this is the meaning. First of all, every one of you, please tell me, did you understand what is the concept of a direct quote or not? Full clarity, everyone? Okay, so what is the concept of a direct quote? Number of units of home currency for 1 unit of foreign currency is called as a direct quote. Okay, when the expression in number of units is the home currency, it's a direct quotation. Okay, first write down up to here. Completed? Everyone completed copying the answer? Okay. Now, so we completed the concept of direct quote. Next, write down number 4. So third question also completed. Let's come to the fourth one. Indirect quote and example. Same two branches. Branch 1. Branch 2 example. First concept. Same reversely we have to write. Number of units of foreign currency for 1 unit of home currency. Number of units of foreign currency. Here also see, there are two currencies. One is a foreign currency, another one is a home currency. Again, indirect quotation is also a expression between two currencies. In that one will be Indian currency, another one will be the foreign currency. Previously also two currencies are involved, Indian currency, foreign currency. Now also two currencies are involved, Indian currency, foreign currency. The way of expression only will change. Okay. Previously, number of units of foreign home currency for 1 unit of foreign currency we saw. Now what we will do, number of units of foreign currency for 1 unit of home currency we will see. It's just a reverse. Okay. So write down. Let me use calculator on my mobile phone. I did not bring even today. I am the most impunctual student. I said to you, but I forgot to bring calculator again today. But you bring, because at least you are there for me to help. Okay, even if I forget. If you forget, no one will help. So, example, I will first write example, later in calculator I will do and I will tell. Okay. See, 1 rupee equal to how many dollars we have written previously? $1 equal to 84. So 1 divided by 84. $0.1190. Always remember, generally if nothing is said in the question, in any forex question, 4 decimals, so you should round off. If he clearly says that use 6 decimals, use 6. If he say clearly use it for 3, 3. If he says round off to 2, use 2. Nothing is said 4 decimals. Okay. For example, if you get 0.1198, then round it off to the next number. Okay. Now, so now 1 rupee equal to rupees 0.1190. Next, 1 rupee equal to how many pounds? I said 1 pound equal to 102. 1 rupee equal to how many pounds? 1 divided by 102. Pounds 0.0980. 0.09. Sorry. 0.0098. 0.0098. 0.0098. Next, 1 rupee equal to how many euros? 1 divided by 91 in our example. .0109 is there now? 110 you can write. 0.0098 you got. 0.01098. So 98 means we should round up to 1 0.011. That's it. Okay. So everyone tell me, did you understand expression on both the sides clearly? Yeah. Everyone, both direct quote and indirect quote meanings, did you understand? Everyone, participate, reply. Participate, reply. That's your duty. Participate, reply. Okay. Now the question. What you have done for to calculate this? For calculating the first one, we have done 1 by 84. Next 1 by 102. Next 1 by 91. 84, 102, 91 is a direct quotes. 84, 102 and 91 is a direct quote. To calculate indirect quote, we just did 1 by. That's why write down in a box. Indirect quote equal to 1 by direct quotation. Indirect quote equal to 1 by direct quotation. That's why indirect quotation is inverse of direct quotation. Indirect quotation is a inverse of direct quotation. Now you people should answer. Up to here all the basics, the 4 concepts we learned. Are you all having a clarity on all the 4 concepts we have done till now? Everyone. All the 4 concepts. Everyone. Okay. Now listen carefully. My discussion does not end here. Listen. So what we learnt in the first 4. What I will do is 4 questions I will take. First 4 questions will come in. Again I will revise. Such that you will also get a clarity. Types of markets. There are 3 types of markets popularly. One is a capital markets where the stocks and securities are bought and sold. Money market, money will be borrowed and lent. Currency market, foreign currencies bought and sold. 1 point completed. Foreign exchange quotations are 2 types. Direct quote, indirect quote. Direct quote means 2 currencies will be there. Quotation means it's an expression. Expression of what? Expression of value between 2 currencies. Expression of value between 2 currencies. Wherein home currency will be in number of units. Foreign currency will be in per unit. Foreign currency will be in per unit. Next. Indirect quotation means again same. It is a expression. Expression of what? Value of 2 currencies. In what way? In number of units la foreign currency, per unit la home currency will be there. Clear everyone? Okay. Now if you go, sir, I didn't understand, sir. I understood concept, sir. What you said super, sir. But I have one doubt, sir. Student will get a doubt. Definitely this doubt you must have got. Sir, when direct quote is already there, why indirect quote came into the existence? Anyone in the class can tell. When, sir, obviously one question I can tell. Whenever you are buying something, that buying, what you are buying is a commodity. Commodity will be in per unit terms. Commodity will be in per unit terms. I will give you an example here. I will give you an example. What is the cost of this pen? Pencil, Apple pencil, 10,000 rupees. How much here? 10,000 rupees is the cost of this pencil. Okay, how will you express this here? One pencil, Apple pencil equal to 10,000. I will write. One Apple pencil equal to rupees 10,000. Number of units of rupee and home currency for 1 unit of commodity. 1 unit of commodity. Means what? Point is, one pencil, if you wanted to buy Apple pencil, you need to spend how many 1 rupee coins? I need to spend 10,000 units of 1 rupee. That's why they said this is a number of units for 1 unit. So 1 unit of pencil required 10,000 units of 1 rupee coins. Understood? That's the meaning. Okay. So commodity will be always expressed in 1 unit only, always, anywhere. Units, 1 unit, 2 units, like that they can tell. Correct or not? Now I'll ask you a question. Will anyone tell, okay, 1 Apple pencil equal to 10,000 rupee? Is it direct quotation? Is it direct quotation? Will anyone tell, okay, will anyone tell, I will pay you 700 rupees. I will pay you 700 rupees. Tell me how many Apple pencils will I get? I will give you 700. One pencil, if it takes 10,000, 700 rupees ki how many pencils will come? So what you have done? 700 divided by 10,000. 0.07 pencil. 0.07 pencil. Right or wrong? 0.07 pencil. Right or wrong? 0.07 pencil you will buy. You will go to shop and tell, what is the cost of Apple pencil? That fellow answered 10,000. Oh, I have 700 rupees na. Please give me 0.07 Apple pencil. Like that you will do. 0.07 Apple pencil you will buy. No, you won't buy like that. It's not possible. Okay, it's not possible. Then this looks like same. One Apple pencil equal to 84. Like that you can read now. $1 equal to 84 rupees. Okay. Commodity is a dollar. $1 equal to 84 rupees. That's it. That's the way in which we should tell. No, sir. I will give 1 rupee. Tell me how many dollars will I get? This is like 700 rupees ki how many Apple pencils will come in. Are you understanding or not? Then 0.07 Apple pencils you will get. Like that who will express here? No one will do. Then why we are doing? Okay. So now the question starts. From here the real story of foreign exchange chapter started. Direct quotation, indirect quotation. Okay, I will write one question here. I will write one question. First, try to answer. What I said, concept is important, not bloody remembering the concepts. Okay, I hate that way of understanding and learning. Mugging up the concepts, somewhere in the books you copy down. Okay, if this comes, this like that. If this comes, we should do like this. I hate that way of understanding. So understand the concept first and then you give the answers to me. Okay, I will write here, try to answer. Okay, I will write here, please try to answer. $1 equal to rupees 84. This is a direct quotation, DQ or IDQ. This is a DQ or IDQ. This is a DQ or IDQ. Answer everyone. Fast. I should get that 75 people who are live. Everyone should answer. This is a DQ or IDQ. Okay. So this is a DQ. This is a DQ. Wrong. Okay. So this is DQ is wrong. This is a DQ only in India. I told in most of my sessions. Okay, I told in most of my sessions very clearly. Always quotation is dependent on the country. Quotation is dependent on the country, not dependent on any other thing. Depending on the country. In India, this is a direct quotation. In India, this is a direct quotation. Understood the point or not? Because for Indians, commodity is dollar. For Indians, commodity is dollar. Like this if I tell, people may not understand. Therefore, I will give you a fantastic way of presentation to understand this concept of DQ and IDQ very clearly in details. Let us try to understand. Okay? See. First point number 1, 3 markets are there. We completed. 2 quotations are there. Direct, indirect. What is a direct quote? Number of units of home currency for 1 unit of foreign currency. What is indirect quote? Reverse. Number of units of foreign currency for 1 unit of a home currency. That's called as indirect quote. Now the question. How to understand any given quotation and how to imply that. Okay. How to interpret that. Okay. First point number 1. The main problem that comes with the Forex chapter is Okay, LHS, RHS, both are commodities. That's the problem. Sir, I didn't understand, sir. I will give one super duper example. What is this here? Okay, I will give you one example now. I said, what is this? Reply, what is this? So, this is a water bottle. Correct? Anyone will answer the same. This is a water bottle. Now listen carefully. I am not doing any joke here. I am not going to create any fun here. Let's understand in a right way. Okay? Listen, I have a water bottle with me. Now answer to my question. We are in India. We are in India. Tell me, as a Indian, you have to buy this by giving some rupees. Correct or not? You have to buy by giving a rupee, some number of rupees. Okay? I said this is 10 rupee. I said this is 10 rupee. How will you write? One water bottle equal to rupees 10. One water bottle equal to rupees 10. Okay. Now you went to USA. How you will write? One water bottle equal to $2. Like that you can write. Example, $1, one water bottle equal to $2. Like that you can write. You went to UK. One water bottle equal to pound 1.2. You may write like that. Now you answer to my question. Whether you are in India, whether you are in USA, whether you are in UK, one thing is common. What is that one thing is common? Water bottle is the commodity. What is the commodity? Water bottle is the commodity. From this, what you have to understand? Commodity don't change with the country and country. Water bottle is a commodity in India. Water bottle is not a commodity. Water bottle is the exchange in USA. No. Water bottle is a commodity in India. Water bottle is a commodity in USA. Water bottle is a commodity in UK also. Clear? Now listen carefully. Take an iPhone now. iPhone is a commodity in which country? Every country. In US also they wanted to buy one iPhone, means how much they will ask. I wanted to buy an iPhone, tell the cost. In India I want to buy one iPhone, tell in rupees how much. Every country, iPhone is a commodity. Every country, water bottle is a commodity. Every country, dollar is not a commodity. That's the reason. Dollar is not a commodity for every country. Dollar is a commodity for every country except USA. USA dollar is not a commodity. Dollar is a payment against the commodity. Clear? For India, rupee is not a commodity. For UK, pound is not a commodity. Commodity means which we don't have. Commodity means, listening or not, commodity means which is not a payment model. Rupee is a payment model in India. Rupee can't be a commodity. You don't buy and sell rupee. You will buy something against rupee. So, the first doubt in the chapter Forex starts just because of lack of clarity in the basics. Mark my words. If any person is feeling difficult with the Forex chapter, options and futures and derivatives, that is only because of one reason, lacking clarity in basics. Okay? Because fashion world people want, sir, everything complete in 10 hours, basics, no need directly question answer. Okay? So, in that nothing you will get. So, try to understand, have the basics properly. Problems you can also do on your own, if you understand the concept clearly. So, the point again I wanted to repeat. Everyone, listen carefully. Country to country, commodities won't change. iPhone, commodity. Water bottle, commodity. Laptop, commodity. iPad, commodity. Okay. So, what you have to understand from this, these are all commodities, same across every country. Foreign exchange la problem is that commodity. Do you know why? Commodity for one country may not be a commodity for another. Dollar is a commodity for you in India, but dollar is not a commodity for them. Dollar is the payment model for purchasing any commodity in USA. First of all, everyone acknowledge the fact that you understood. Everyone in the live, first acknowledge the fact that you understood. Yes or no, you tell either of the things. Okay. Here the problem started. Since it is a commodity for one country but not a commodity for another, USA won't buy dollar as a commodity. USA will buy rupee as a commodity. So, indirect quotation for you will become the direct quotation for USA. That's why indirect quotations are there in Forex. Okay, for you rupee may not be commodity, but for a USA person, rupee a commodity. How he will see to buy a rupee, how many dollars I need to spend? That's why it's like this. Okay, please write down. 1 minute time. No, no, not even 1 minute. Less than 1 minute time. Please read properly. If you have written, okay. If you did not write, copy down the notes. Completed? Okay. Sir, have you all done with this? Copied? Next one. So we completed concept of direct quote, concept of indirect quote, and how to convert direct quote into indirect quote. So indirect quote is nothing but 1 by direct quote. That's it. Remaining everything is same. Next. Number 5. So 4 questions completed. Fifth one. Identify whether the following quotes given by a Mumbai banker, means Indian, is a direct or indirect quote. Compute the direct on rupee to indirect quote and vice versa. If it is a direct quote, convert into indirect. If it is an indirect, convert into direct quote. That's what he is asking. First, read the question. These are all some study material, old study material questions. Since basics, I kept these questions first. First, let us understand the rudimentaries, the basics of this chapter clearly. Identify whether the following quotes given by a Mumbai banker is a direct or indirect quote. Compute the direct quote on rupee to indirect quote and vice versa. Okay? Okay. Let's take the data first. Write down. Conversion of quotes. Conversion of codes. Okay. First write down serial number, exchange rate, original expression, conversion, converted quotation. Easy concept only, but will make you understand some important points. Write down. Number 1, exchange rate. $1 equal to rupees 60. Okay, original expression, what is this? Okay, for a Mumbai banker, what is this original expression? Direct quote or indirect quote? Direct quote on dollar against the rupee. Means commodity you wanted to buy na direct quote on a dollar against rupee. Conversion, we wanted to convert this into indirect quote on dollar against a rupee. How to do? Indirect quotation equal to 1 by direct quotation, that equal to 1 by 60. 1 divided by 60. Converted quote you write down 1 rupee equal to dollar 0.0167. 1 rupee equal to dollar 0.0167. First of all, everyone tell me, understood the concept clearly up to here? Next one. Number 2. 1 rupee 100 equal to 0.1.6. Very good question. Rupees 100 equal to 1.6. When quotation is given like this, none of them is a per unit. First, what you need to do is, first convert this into per unit. Okay. Like this I will write. You can write either ways. In one way I will write. I can rewrite this as follows. 1 rupee equal to pound 1.6 divided by 100, 0.016. Okay. So now tell me, this is what kind of quotation? Write down. This is an indirect quotation on pound against rupee. In India we are talking about. That's an indirect quotation on a pound. Commodity is the pound here. So indirect quotation on a pound against a rupee. Next, we wanted to convert that into direct quotation on pound against a rupee. How to write? Write down the formula. Direct quotation equal to 1 by indirect quotation, that equal to 1 by 0.016. 1 by 0.016. 1 divided by 0.016, 62.5. So 1 pound equal to rupees 62.5. Everyone understood also this calculation clearly? How to convert the indirect into direct? Everyone understood how to convert indirect into direct? Okay. Next issue. Number 3. Rupees 100 equal to DM 4.7. Let's do together. DM means Dutch marks, Germany currency. Amsterdam, all these currencies is Dutch marks, 4.7. Okay, first write down in one way. Now you write down in a reverse way. One you have converted into 1 rupee terms. Now let us convert into 1 DM terms. 1 DM equal to 100 divided by 4.7. Rupee 21.2766. 21.2766. Previous one rupee point la I have written. Reverse la I am writing now. When it is given in none of the one unit currency, you can convert into any way possible. One I have done in one way, the second one I am doing in a different way. Okay. Next, this is what? This is a direct quotation on DM against a rupee. Now we wanted to convert it into indirect quotation on DM against a rupee. How to do? Indirect quotation equal to 1 by direct quotation. 1 by 21.2766. So 1 DM equal to, 1 rupee equal to indirect quotation DM 1 divided by 21.2766. 0.0470. 0.0470. Next, fourth one. Final touch. 1 N equal to rupees 0.3. Okay, so with 1 N you will get only 0.3 of a rupee. What is this currency quotation? This is a direct quotation on N against a rupee. We want against a rupee. Indirect quotation equal to 1 by direct quotation 1 by 0.3 3.3333. So how to write this? How to write this final quotation? 1 rupee equal to Yens 3.3333. Always I said now 4 decimals you have to take in Forex. So 1 rupee equal to Yens 3.3333. Okay. First of all, everyone tell me all the first 4 questions, 5 questions we have done now. All the 5 basic questions, rudimentaries of this Forex chapter. Everyone understood clearly or not? Everyone clear? Yeah. So we completed various types of markets, various quotations, understanding direct quote, understanding indirect quote, identification of transactions, okay, and how to convert. this is the end of day 1 of the Forex chapter. Okay, because the next chapter, the next concept onwards, complete discussion will change. We will come from the exchange quotations to the banker quotations. From there, the real difficulty of this chapter will start. Okay, let's have a clean slate of mind before we start with this area called as a banker quotation. Okay, not at the end of the sessions I wanted to start this, at the beginning of the session I wanted to start. Okay, full clarity though we will start from 6th one. Okay, tomorrow class target will be from 6th we need to complete up to 17. That will take 1 to 1.5 hour time. Let's take 1 hour 15 minutes time average. After that we need to start with question number 18. Okay, as many number of problems as we can, but at least the target is 6 to 7 problems. So here from 6 to 17, 6 to 17, around 12 problems. After this 12 problems, again another 6. Tomorrow's target will be 18 to 20 problems we will solve. We will solve. Okay, what I said at the beginning, I will take a lot of time in explaining the concepts, everything. Problems wise, we will do together and we will complete. Okay, so this is the concept what I wanted to tell. Okay, so one last time I will explain this concept fastly, listen, and then we will close the session for today. Please listen carefully from the beginning. First one, what are the various types of markets? There are 3 types of markets, namely, first one is the capital market, second one is the money market, third one is the currency market. Capital markets is a place where the securities are bought and sold. Money market is a place where money is bought and sold. Currency market is a place where foreign currencies are bought and sold. Over. What are the various foreign exchange quotations? There are 2 types of foreign exchange quotations. One is a direct quote, another one is an indirect quote. What is a direct quote? Direct quote is expression of one currency against another currency, in which one is a home currency, another one is a foreign currency. So now tell, what is a direct quote? Number of units of home currency for 1 unit of foreign currency is called as a direct quote. Reverse, number of units of foreign currency for 1 unit of home currency is indirect quote. Indirect quote equal to nothing but 1 by direct quote. Okay, so then we understood this. Original quotation in problem number 5. Originally is $1 equal to rupees 60. Originally this is a number of units of home currency for 1 unit of foreign currency. This is a direct quotation on dollar against rupee in India. We will convert that into indirect. Indirect means not 1 by direct. So 1 by 60, this is how you will write. Okay. In India, no one will buy rupee by giving dollar. In India, we will give dollar and take rupee. Okay. Or we will give rupee and buy dollar. But this is an expression. Indirect quotation is always a reverse currency expression. In USA, people's commodity is not dollar. People's commodity is rupee. They will express in the indirect quotation format. Okay. Same. Second one, pounds. Third one, DM. 100 rupees equal to DM 4.7. 100 rupees equal to DM 4.7. So you can write in 2 ways. Either you can write in 1 rupee equal to 0.04. Like that you can write in DMs. Okay. Or 1 DM equal to 21.2766 DM rupees you have to spend. Indirect quotation means what? Reverse. 1 by 21.2766. 1 rupee equal to DM 0.0470. Okay. Final one again conversion to the same. Okay, everyone understood clearly? So, one person asked the doubt, sir, 1 rupee equal to DM 0.047 is indirect quote. Yes, it's an indirect quote on DM against rupee in India. Commodity is expressed in a reverse way. Therefore, it's an indirect quotation. Clear? More about direct, more about indirect, how to understand bankers' quotations, everything. Tomorrow's class, la first 1.5 hour we will discuss. Okay? If you miss the beginning in the tomorrow's class, gone. Gone, I say. That's it. Because the concepts, everything will be there in that particular first 1 hour, 1.5 hour discussion only. If you understand those basics properly, any problem given in the exam, you will be able to answer. Okay. So, this is a point I wanted to convey with regard to the first part of the Forex chapter discussion. So, hopefully everyone is having a full clarity. Everyone? Everyone is having a full clarity? One reply before we leave. Okay. So thank you. Tomorrow I will repeat this one more time and I will clarify the doubts and then we will be going into the next area. Okay. So thank you very much. Tomorrow's session we will continue and complete the remaining parts. Okay. Thank you. And moreover, from tomorrow YouTube session will not be there. This is the third YouTube session. Just to add the people, we reached 300 mark. We are stopping the admissions now. 300 mark though we are stopping. At least in the WhatsApp group we are not putting more than 300 in all these 5 groups we form. So from tomorrow onwards, you can join the live. From then you can continue the live. If anyone wanted to take the live classes, you can take and you can continue. But the point is, in WhatsApp group, any of the WhatsApp groups, we will add you. You can clarify your doubts, everything. Because yesterday another 22 students joined. I added 6 people in group 1, 6 people in group 2, 6 people in group 3. Like that added. Now each group having around 75 people. Okay. If you have any doubts, you can put the question in your WhatsApp group. At my free time, I will definitely answer all your queries. Okay. So this is the end of the today's session. From tomorrow onwards, no YouTube live session for this. In-app live classes will start. It's an encrypted format. So again, I am telling you, don't take screenshots of the screen. YouTube now you can do anything. But with regard to the app, if you take screenshots or try to record the screen, from there the app will stop working. You may face problem. So therefore I am telling you in advance, please don't take a screenshots or screen record. Once you do that, immediately app will stop working because that's an encrypted video. Okay. So thank you very much. Meet you tomorrow live 7:15 we will start till 11:40, 11:45 I will take, maybe 12 also. Let's complete the targets and complete the syllabus on time. Okay. So all the very best. Tomorrow we'll meet again. Thank you very much.